I've had a few people reach out to me to ask me about the 5 minute opening range break strategy that I use with the fair value gap to ask if it applies to anything other than futures. And today's a really good example. I know the whole entire market was down, but you could pretty much backtest this for the last 30 days and find multiple winning days. Where on the 5 minute opening range break, if you wait for your candle to break outside of the zone and then wait for a fair value gap to present itself, if you would have started looking at puts or calls during that time for options trading, you also would have been able to utilize this to do zero DTE expirations on QQQ or SPY and make a couple $100. Let me show you what I mean. So this right here is QQQ, and we know the whole market was down today, but if you were just watching it, you would have been able to see that right in pre-market, things start not looking so good. But you wait for the first, we're sitting here at 940. So we're 10 minutes into market open. You can see you have your 5 minute opening range, your high and your low, and then extremely small bullish candle. I can't even call that a candle, followed by a bearish candle that breaks out of the low of the 5 minute opening range. Then if you're just continuing to watch the market in the first 25 minutes, you can see that a fair value gap has presented itself right here. Even if you were to buy down here, at the absolute lowest that it's been, that's 617 for the day. Now, if it were me, I used to do options quite a bit. I was okay at it, but I prefer futures more. On this one, I probably would have looked at like put for 615, probably would have ran, I'm going to assume around $160 for that put call or for that put option. And let's just say that's where we would have went. We would have went for 615 right here. I would have took that on a expiration date of today, and then I would have just let it play out. You can see here that by about this time, I'm feeling pretty good. I'm probably offloaded right now, and it's not even 11 o'clock East Coast. I am definitely profitable. I'm $3 below what my put option would have been there. And if you would have jumped earlier, you would be significantly in the money, but this contract would have paid out very well if you would have taken that. But I know you're probably like, hey, Aaron, of course, today was a red day. Everybody knows that. Let's go look at a different day just to verify this. Let's pick a random day. So here's another one right here. This is even scrolling back just to confirm it. Random day, the 22nd of October, 9:30, big opening range candle, 610, almost 611 to 608. Call it 609 because it's close. Kind of around, big drop, recovery. There's a fair value gap right here. Just wait for the break. Goes above, and we're waiting for a fair value gap, never comes up, and then immediately starts reversing. Okay, here, this candle would have closed at 10:30. You definitely have a fair value gap that broke below, and the fair value gap is below the 5 minute break as well. So let's just say right here at this candle closure, you're at 607. You look for a put somewhere in the 605 range, costs you a couple $100. But if you're only holding it on a 0 days to expiration, let's say you just take it at 605. This gap was never reclaimed. They're trying to get it, almost got it. And you can see right here at 12:20, about 40 minutes before market closed, it was down at 604. You would have been selling the 605 option for profit. Now, of course, on this, you don't need to cross-reference it with SPY because SPY and QQQ essentially follow the same, just like NQ and ES do in futures. If one of them is going down, they're both most likely going down. You could have traded either one of them. You can use the 5 minute opening range break on either of these if you're looking at your charts.